Welcome to the debate. Today we are looking at Minerals Technologies, Inc., which we will be shorthanding as MTX. The central question we are answering today is whether this stock is a pristine, deep value opportunity or, frankly, a highly leveraged value trap that is hiding behind some very opaque disclosures.
Right.
Our screening pipeline passes MTX with a massive 33.7% margin of safety. Yet our machine learning distress model has classified it as an absolute reject for 5 consecutive years.
P1.
Yep.
5 years.
Protecting. MTX is a specialty minerals manufacturer, pulling in roughly $2.1 billion in revenue, page 1. When we run the Penman residual income model, which is essentially a way to calculate what the business is intrinsically worth based on its future economic profits, it places the intrinsic value at $2,696 million against the live market cap of just $2,017 million. So the upside case here fundamentally relies on stable margin floors and a real cash flow recovery. Joining me to parse this thesis are two of our top voices. We have the advocate arguing the fundamental valuation and quality case, and the dissenter bringing the forensic, credit, and risk perspective. Let's get right into the position statements. Advocate, you are up first.
Yeah, thanks. I completely see why the machine learning model flagged this, but let me give you a different perspective based on the actual underlying fundamentals. The bull case rests on 3 very solid pillars. Pillar 1 is this deep value disconnect. The market is effectively pricing in a perpetual growth rate of negative 2.15%, page 15. I mean, think about what that means. The market expects this business to permanently shrink. That is sheer capitulation. The Penman model shows a 33.7% upside that actually persists even under a stress test scenario. Like, even if their borrowing costs, their weighted average cost of capital, jump by a full 100 basis points, the discount is a mathematical reality. Page 15. Pillar 2 is structural margin resilience. Despite the forensic noise you're definitely about to hear from the other side of the table, MTX boasts a margin stability score of 76.7 on page 4. Their operating margin, which measures core profitability after production and running costs, recovered to 12.9% in fiscal 2024 according to the Simfen data on page 5. That demonstrates immense pricing power in a heavy, capital-intensive industry. And finally, Pillar 3 is the cash flow inflection. We are looking at a structural recovery here. Free cash flow margin hit a working capital-driven trough of 1.1% in fiscal 2022, but it has rebounded to a robust 7.5% in 2024. The unit economics, the actual cash profit generated on each ton of specialty mineral they sell, are sound. The market is treating a transient integration headache like a terminal decline, and that is exactly where our margin of safety comes from.
Well, I come at it from a completely different angle, and frankly, I don't buy that margin of safety at all. My case is built on 3 pillars that show a deeply fragile company, one where that 30% discount is entirely justified by the risk. First, razor-thin solvency. You tout the free cash flow, but their net debt to free cash flow sits at 5.96 times, P2.
It's elevated, sure, but
It's not just elevated, it's fragile. Look, if free cash flow drops by just $4 million, which is essentially a rounding error for a $2 billion company, they hit a ceiling that triggers a 6.0x hard veto on their debt covenants, page 13. It is like walking a tightrope over a canyon in high winds. Furthermore, reported interest coverage, their ability to pay debt interest from their earnings, is 1.16 times according to Morningstar data, page 3. That is far below our 2.0x standard, and it only passed the initial screen via a highly questionable override. Pillar 2 is a complete forensic disclosure collapse. MTX scored a 3 out of 10 on our candor metric, page 9.
That's just an algorithm.
Let me finish. There are exactly 0 extractable, testable claims in their 2024 Management Discussion and Analysis, page 9. 0. Capital allocation discipline makes up 31% of the disclosure weight, but it contains literally 0 numbers, page 10. No target return rates, no hurdle rates. They're talking a lot without actually saying anything. And Pillar 3. Unexplained financial shocks. First quarter 2025 net income collapsed to negative $144 million despite positive operating income. Page 6. That implies a massive, unexplained $204 million below-the-line charge, which is highly likely to be a goodwill impairment from their Concept Group acquisition. Page 6. When management hides the numbers and the balance sheet is this heavily leveraged, that quote-unquote deep value discount isn't an opportunity. It is a trap.
Okay, the battle lines are very clearly drawn here. We have a debate between severe solvency tightropes and absolute valuation cheapness. Dissenter, I want you to lead the cross-examination. I want to hear the strongest challenges to the fundamental quality of this business, and advocate, I want you pushing right back. Let's do this rapid fire.
Gladly. Let's start with return quality. You are calling this a deep value opportunity, but how do you justify a plus 33.7% margin of safety when the return on invested capital, or ROIC, is trapped at 9.72% on page 14? That completely fails the basic compounder threshold of 15 to 25% on page 14. So how efficiently are they actually using shareholder capital?
That is an interesting point, though I would absolutely frame it differently. We aren't underwriting this as a high-flying compounder. It's classified in the system as Track 2 Deep Value, page 4. An ROIC of 9.72% still exceeds their cost of capital. They are creating economic value, just modestly. And my question for you, doesn't the margin stability durability score of 76.7, page 4, prove that the underlying cash-generating model is structurally solid, despite all your forensic noise?
Margin stability means absolutely nothing if the cash flow doesn't convert to the bottom line because of massive debt servicing. Which brings me to the leverage. With net debt to FCF at 5.96x, page 2. How can you underwrite this as safe when a microscopic $4 million deterioration in free cash flow triggers our 6.0x hard veto, page 13?
I don't love the leverage, I'll concede that, but your 5.96x figure is a trailing metric anchored by one uniquely bad quarter. My turn. You quote the Morningstar 1.16x interest coverage ratio to make them look insolvent, page 3. But doesn't CIMFIN show a trailing series with a 4.4x normalized coverage, page 12? Aren't you just weaponizing a gap distortion from a one-time impairment charge to make the credit look vastly worse than it really is?
It is not weaponization. It is respecting the veto thresholds. A $204 million impairment, page 6, destroys the equity buffer. But let's look at the operations then. Operating income collapsed 45.4% quarter over quarter in Q4 2024 on only a 1.3% revenue decline. Page 6. How do you accurately model margins when the company provides zero explanation for a drop like that?
Quarter-to-quarter volatility in industrials is normal. It's often due to inventory provisioning or seasonal cost absorption. What matters is that for the full year 2024, the operating margin expanded to 12.9%, page 5. Let's address your forensic attack. You hammer the 3 out of 10 candor score, page 9. But isn't a drop in MD&A specificity just typical conservative legal counsel behavior post-acquisition? When a company buys another, the lawyers tighten the script. That is not proof of some massive fraud.
Intellectual charity is essential, but let's be realistic here. The MD&A specificity score hit a 25-year low of negative 1.47, page 9. That is deliberate obfuscation. Speaking of algorithms, if the structural trend is so great, why does the machine learning distress model, which ranks FCF margin as its absolute most important feature, assign MTX a reject for 5 straight years? Page 14. Why are you assuming the